Good morning. This is Crystal Biting, Vice President, Investor Relations and Financial Planning and Analysis for the SJM Smucker Company. Thank you for listening to our prepared remarks on our fiscal 2026 third quarter earnings call. After this brief introduction, Mark Smucker, Chief Executive Officer, President, and Chair of the Board, will provide a business and strategy update. Tucker Marshall, Chief Financial Officer, Executive Vice President, Frozen Handheld and Spreads, and Sweet Baked Snacks, will then provide a detailed analysis of the financial results and our updated fiscal 2026 outlook. Later this morning, we will hold a separate live question and answer webcast. During today's discussion, we will make forward-looking statements that reflect our current expectations about future plans and performance. These statements rely on assumptions and estimates, and actual results may differ materially due to risks and uncertainties. Additionally, please note we will refer to non-GAAP financial measures which management uses to evaluate performance internally. I encourage you to read the full disclosure concerning forward-looking statements and details on our non-GAAP financial measures in this morning's press release. Today's press release, a supplementary slide deck summarizing the quarterly results, management's prepared remarks, and the Q&A webcast can all be accessed on our investor relations website at jmsmucker.com. We invite all interested parties to join us at 9:00 a.m. Eastern Time today for a live question and answer session with management to further discuss our third quarter results and outlook for the full 2026 fiscal year. Please contact me if you have any additional questions after today's question and answer session. I will now turn the discussion over to Mark Smucker.
Thank you, Crystal, and good morning, everyone. In the third quarter, the company's positive momentum continued, and our results exceeded our expectations. We delivered another quarter of strong top-line growth, driven by the ongoing demand for our leading and iconic brands and higher growth brands as we continue to realize the benefits of our transformed portfolio. Our bottom line performance reflects disciplined cost management, and we delivered sequential improvement in adjusted earnings per share. As we look ahead, we are focused on three distinct objectives. First, we will continue to advance our long-term growth strategy and further the momentum of our portfolio of leading brands. Second, we are highly focused on improving profitability and driving earnings growth across the company. And third, we remain committed to a disciplined capital deployment model that prioritizes organic growth opportunities, debt paydown, and shareholder return in the form of dividends and share repurchases, while maintaining our current investment-grade debt ratings. Each of these objectives builds on how we have transformed our portfolio through a focused strategy centered around engaging and delighting consumers by participating in attractive categories, building brands consumers love, and being everywhere consumers shop. This approach has created a complementary and cohesive portfolio across the company, supported by our enterprise-wide marketing capabilities, disciplined commercial execution, and a connected manufacturing and supply chain network. Our third quarter results continue to demonstrate that our strategy is working. Total company comparable net sales increased 8%, and when excluding contract manufacturing sales related to the divested pet food brands, net sales increased 9% versus the prior year. Nearly 2/3 of our portfolio is growing or maintaining dollar share, while more than 3/4 is growing or maintaining volume share in measured retail channels. We are focused on continuing this momentum by prioritizing resources towards our largest growth opportunities, the Uncrustables, Café Bustelo, Milk-Bone, and Meow Mix brands. I'll dive deeper into each of these. Starting with the Uncrustables brand, which grew net sales 10% at the total company level. This fiscal year, we expect to achieve our $1 billion annual net sales aspiration for the Uncrustables brand. The brand has added approximately 3.5 million new households over the past year and continues to over-index to households with kids and millennials. With household penetration at just 26%, we continue to see a long runway for growth. We are fueling this momentum through consumer-led innovation and being everywhere the consumer shops. In innovation, we recently announced fridge-friendly Uncrustable sandwiches, which will be available across all flavors starting this summer. Now, in addition to being kept in the freezer, all Uncrustable sandwiches will be able to be kept fresh in the fridge for up to 5 days, making it easier to enjoy at a moment's notice, increasing convenience and expanding usage occasions. We are also expanding into morning occasions through our Uncrustable sandwiches that offer 12 grams of protein, up and apple, and bright-eyed berry. These new varieties access an entirely new day part for the Uncrustables brand, focused on breakfast and morning snacking, while also meeting the needs of consumers who are increasingly prioritizing protein throughout the day. These new varieties are off to a strong start, recently achieving $1 million in weekly measured retail dollar sales. We will build on this foundation and plan to expand the platform this spring with a new blueberry flavor. As we look to expand availability, the convenience channel offers a unique opportunity for an immediate consumption occasion. While still early, we have tripled monthly measured retail dollar sales for the Uncrustables brand in this channel versus the prior year. Uncrustable sandwiches are in the top 10% of fastest growing brands in dollars and units across all categories in the convenience channel over the past year, and we expect to significantly expand distribution over time. We are building a truly iconic brand with widespread multi-generational appeal, which we expect to become a top 3 brand in the total freezer aisle. Our next key growth platform, the Café Bustelo brand, continues to deliver strong results and remains one of the fastest growing brands in the at-home coffee category. The brand gained both dollar and volume share in every segment in which it competes, including the mainstream, pre-pack, one-cup, and instant categories in the latest 13-week period. Net sales for Café Bustelo increased 46% within our U.S. retail coffee portfolio, including a 20% increase in volume mix. Growth has been driven by expanded distribution and increased marketing investments. The brand is resonating particularly well with Gen Z and millennials and is further supported by our innovation strategy. Last summer, we introduced new roast profiles to expand the brand from its traditional espresso brew to blends that can be brewed more easily in traditional drip brewers, appealing to younger, more diverse buyers while remaining inspired by its Latin roots. Through our brand-building efforts, we continue to see strong growth in brand awareness and household penetration, both of which have significant runway for continued growth. This fiscal year, we expect the brand to surpass $500 million in net sales, an increase of more than $100 million versus the prior year, driven by both volume and pricing. We continue to make progress on our ambition to make Café Bustelo a top 4 brand in the at-home coffee category. For the Milk-Bone brand, net sales increased 3% in the quarter within our U.S. retail pet portfolio. In the latest 13-week period, the brand grew in both volume and household penetration. Growth was supported by our strategy to maximize and win everyday treating, amplify brand love with new pet parents, and expand consumption through impulse opportunities across innovation and seasonals. As the leading brand in dog snacks, we are fueling the humanization trend through innovation, premiumization, and evolved messaging. We are strengthening our core business value proposition with updated packaging to highlight protein and other functional benefits, while expanding premium offerings through the Milk-Bone Peanut Buttery Bites platform. This collaboration between the number 1 dog snacks brand and the number 1 peanut butter brand has been highly successful. Milk-Bone Peanut Buttery Bites was the #1 dog snacks launch over the past 4 years, and we are excited to expand the platform with Peanut Buttery Cups launching next month. In cat food, the Meow Mix brand continued to see strong growth with both net sales and volume mix increases in the quarter. In dry cat food, the Meow Mix brand continued to outpace the category in sales and drove incremental household growth in the latest 13-week period. Growth continues to be supported by distribution gains, innovation, and marketing investments behind our multi-year Meow Mix Remix campaign. Consumer-led innovation remains a key driver of our growth. Meow Mix Gravy Burst combines the convenience of dry cat food with the excitement and taste of wet cat food. The offering continues to exceed expectations and was the #1 dry innovation launch in the category in 2025. Building on this success, we are expanding the platform with Gravy Burst salmon-flavored cat food and Gravy Burst chicken-flavored treats, now available in stores. The momentum we are seeing across the Uncrustables, Café Bustelo, Milk-Bone, and Meow Mix brands underscores the strength of our strategy and the quality of our portfolio. These brands represent durable growth platforms supported by consumer-led innovation, strong brand equity, and enterprise-wide marketing capabilities. Importantly, they are driving growth today while strengthening our long-term value creation potential. As we continue to invest behind these platforms, we are confident in our ability to sustain this momentum and build leading and iconic brands that play key roles in the life of the consumer. Turning to the dynamics in our U.S. retail segments. In coffee, net sales increased 23%, driven by increases across all formats and brands. Our portfolio is performing well, and we continue to demonstrate our ability to recover increased commodity costs through responsible pricing. Due to higher costs and the pass-through nature of the coffee category, we took a price increase in both May and August of this fiscal year. Since then, price elasticity of demand trends have been favorable to our expectations, demonstrating the strength of our portfolio and the resilience of the at-home coffee category. From a profit perspective, we will not fully recover green coffee tariff costs incurred in fiscal year 2026. However, given the recent changes to U.S. trade policy to exclude tariffs on green coffee, we will lap these costs next fiscal year. Additionally, we are now starting to see moderation in green coffee futures supported by positive signs for next year's crop. Given the pass-through nature of the coffee category, during a period of sustained deflation, we have historically lowered prices and total profit has benefited from the favorable impact. In frozen handheld and spreads, net sales increased 2%, reflecting an increase for Uncrustables sandwiches and Jif peanut butter, and a decrease in Smucker's fruit spreads. Net sales for the Uncrustables brand grew 6% in the quarter. We continue to make strategic investments behind this key growth driver for the company, and we are confident in the brand's long-term growth potential. In spreads, we are evolving our portfolio to meet the needs of the consumer, and one example is Jif Simply. This innovation is specifically designed to meet the evolving health preferences of today's consumers, delivering a simple, limited ingredient recipe without compromising on the taste consumers love. We see a clear opportunity to modernize our spreads portfolio and to elevate everyday meal and snack occasions. In pet foods, net sales decreased 1%, reflecting a decline for the Pepperoni brand and lapping contract manufacturing sales related to the divested pet food brands in the prior year. The Meow Mix and Milk-Bone brands both grew net sales and volume mix in the quarter. The dog snacks category has rebounded in recent periods, and cat food continues to demonstrate strong growth, creating a positive outlook for our portfolio. Both categories remain highly attractive, supported by favorable category tailwinds, including pet population trends, where we expect to see both dog and cat population growth over the long term, the continued humanization of pets, leading pet parents to treat their pets like members of their family, driving further premiumization opportunities, and e-commerce trends, a channel that continues to see strong growth and aligns with evolving consumer preferences, which benefits our portfolio. With the number one brands in dog snacks and dry cat food, Milk-Bone and Meow Mix, respectively, we are well positioned to build on these favorable category dynamics and accelerate growth through our proven brand building model and innovation capabilities. In sweet baked snacks, the path to stabilization is taking longer than we expected. However, our focus remains on positioning the Hostess brand for eventual growth. Third quarter results were below our expectations, driven by executional and operational challenges, higher costs, and the impact of near-term actions we are taking to strengthen the business for the long term, which include reducing our SKU count by 25% to simplify our offerings as we prioritize high velocity and margin accretive SKUs. The majority of this work is now complete, and we anticipate the benefits from operational efficiency and improved customer service to largely benefit next fiscal year. The closure of our Indianapolis manufacturing facility, which will deliver approximately $10 million in cost savings this fiscal year and $30 million annually, and the strategic decision to reduce promotional activity from January to the end of the fiscal year for the sweet baked snack segment, as we work to improve our operations and evaluate where the greatest return on investment will be for the brand going forward. While these actions are expected to strengthen the segment and support long-term growth and margin expansion, they are creating near-term volatility in volume and profitability this fiscal year. Progress on our sweet baked snack stabilization strategy will continue to take time. With this in mind, we will take a prudent approach to investments in the business while ensuring we remain focused on our most compelling growth opportunities for the total company. We remain focused on stabilizing performance and improving profitability in the sweet baked snack segment over time. Finally, in international and away from home, comparable net sales grew 12%. Growth was driven by the away from home business, which grew net sales double digits in the quarter. Our away from home business has seen tremendous growth as we continue to leverage our leading national brands and key growth platforms in away from home channels. We remain excited for the future growth opportunities in these channels across our brands and anticipate strong double-digit growth as the away from home business grows to approximately 10% of total company net sales this fiscal year. Our third quarter results demonstrate our strategy is working, and we continue to take deliberate actions to advance our objectives of driving continued growth, enhancing profitability, and disciplined capital allocation for the company. This includes the recent executive leadership changes, most notably the alignment of our business segments under Tucker and Rob Ferguson, two proven leaders with extensive strategic, financial, and operational experience, who will advance these objectives. This morning, we also announced the board appointments of Bruce Chung and David Singer as new independent directors, both of whom bring strong track records of value creation. These actions further our commitment to board refreshment and follow constructive engagement with Elliott Investment Management. Alongside the rest of the board, Bruce and Dave will support the work underway to advance our objectives, and I am confident we have the right strategy and leaders in place to create value for our shareholders. In closing, I would like to thank our dedicated employees for their unwavering commitment and outstanding talents and contributions. With that, I'll turn it over to Tucker for additional insight on our financials and fiscal 2026 outlook.
Thank you, Mark. Good morning, everyone. I will begin by providing detail on the non-cash impairment charges reflected in our third quarter GAAP results. We recognized a $508 million impairment charge related to the goodwill of the Sweet Baked Snacks reporting unit and a $454 million impairment charge related to the Hostess brand indefinite live trademark. These impairment charges are reflective of both near-term underperformance and a revised long-term expectations for both net sales and segment profit. Our updated assumptions, in conjunction with the underperformance of the sweet baked goods category, led to a reduction of the projected long-term growth rate to 2% for the reporting unit, as well as the decision to begin amortizing the Hostess brand trademark in the fourth quarter. We remain focused on stabilizing performance and improving profitability in the Sweet Baked Snacks segment over time. Now, I'll provide an overview of our third quarter results, then give additional details on our financial outlook for fiscal year 2026. In the quarter, net sales exceeded our expectations, primarily driven by the strength of our U.S. retail coffee portfolio, partially offset by lower than anticipated net sales in Sweet Baked Snacks. Net sales increased 7%. Comparable net sales increased 8%, which excludes prior year sales related to the divested businesses and foreign currency exchange. Comparable net sales includes a $6 million headwind from lapping contract manufacturing sales related to the divested pet food brands in the prior year. The increase in comparable net sales reflects a 10 percentage point increase from net price realization, primarily driven by higher net pricing for coffee. Comparable net sales also reflects a 2 percentage point decrease from volume mix, primarily driven by decreases for sweet baked goods and fruit spreads, and lapping contract manufacturing sales related to the divested pet food brands in the prior year, partially offset by an increase for Uncrustables sandwiches. Adjusted gross profit decreased $28 million or 3% compared to the prior year. The decrease reflects higher costs, inclusive of commodity costs and tariffs, unfavorable volume mix, partially offset by higher net price realization. Regarding tariffs, we realized approximately $79 million in expense in our third quarter, which primarily impacted our coffee portfolio in U.S. retail coffee and international and away from home. Adjusted operating income decreased $32 million or 7%, reflecting the reduction in adjusted gross profit and lapping favorable property taxes, partially offset by lower SD&A expenses. The decrease in SD&A expenses was driven by lower marketing and distribution expenses, partially offset by higher selling expense. Below operating income, net interest expense was comparable to the prior year as the impact of reduced debt outstanding was offset by higher overall interest rates. The adjusted effective income tax rate was 24.3% compared to 23.7% in the prior year. Factoring in all these considerations, along with weighted average shares outstanding of 106.9 million, third quarter adjusted earnings per share was $2.38, a decrease of 9% versus the prior year. Turning to our segment results, in the U.S. retail coffee segment, net sales increased 23% versus the prior year. Net price realization increased net sales by 23 percentage points, reflecting higher net pricing across the portfolio to recover increased costs. Volume mix decreased net sales by 1 percentage point, reflecting decreases for the Dunkin' and Folgers brands, partially offset by an increase for the Café Bustelo brand. U.S. retail coffee segment profit decreased 5%, primarily reflecting higher commodity costs and tariffs, unfavorable volume mix, and lapping favorable property taxes in the prior year, partially offset by higher net price realization. In U.S. retail frozen handheld and spreads, net sales increased 2%. Net price realization increased net sales by 2 percentage points, driven by higher net pricing for Uncrustables sandwiches, partially offset by higher trade spend for peanut butter. Volume mix was neutral to net sales, reflecting an increase in peanut butter, mostly offset by a decrease in fruit spreads. U.S. Retail Frozen Handheld and Spread segment profit increased 4%, reflecting higher net price realization and lower pre-production expenses primarily related to the new Uncrustables sandwiches manufacturing facility, partially offset by higher costs and unfavorable volume mix. In U.S. Retail Pet Foods, net sales decreased 1% versus the prior year. Volume mix decreased net sales by 2 percentage points, driven by lapping contract manufacturing sales related to the divested pet food brands in the prior year and a decrease for dog snacks, partially offset by an increase for cat food. Net price realization was neutral to net sales, reflecting higher net pricing for cat food, mostly offset by lower net pricing for dog snacks. U.S. Retail Pet Foods segment profit increased 4%, primarily driven by lower marketing spend. In the Sweet Baked Snacks segment, net sales decreased 19%. Excluding non-comparable net sales in the prior year related to the divested Voortman business and certain Sweet Baked Snacks value brands, net sales decreased 11%. Volume mix decreased net sales by 10 percentage points, reflecting decreases for snack cakes, donuts, and breakfast. Net price realization was neutral to net sales. Segment profit decreased 78%, primarily reflecting higher costs, unfavorable volume mix, and higher marketing spend. Lastly, in International and Away From Home, net sales increased 12%. Excluding $2 million of favorable foreign currency exchange, net sales increased 12%. Net price realization contributed 11 percentage points to net sales, primarily driven by higher net pricing for coffee. Volume mix was neutral to net sales as increases for Uncrustables, sandwiches, and coffee were mostly offset by decreases for fruit spreads, portion control products, cat food, and peanut butter. Net sales for the Away From Home business increased 15%, primarily driven by coffee and Uncrustables sandwiches. Net sales in the international business increased 6% on a comparable basis, primarily reflecting an increase in coffee. International and Away From Home segment profit increased 17%, reflecting higher net price realization, partially offset by higher costs, tariffs, and unfavorable volume mix. Third quarter free cash flow was $487 million, compared to $151 million in the prior year, reflecting the increase in cash provided by operating activities and a decrease in capital expenditures as compared to the prior year. We finished the quarter with a cash and cash equivalent balance of $53 million and a total net debt balance of $7.3 billion. Our trailing 12-month adjusted EBITDA is approximately $1.8 billion. Based on this, our leverage ratio currently stands at 4.1 times. We plan to prioritize debt reduction by paying down $500 million of debt annually this fiscal year and next. With this expected debt reduction and overall business growth, we anticipate a leverage ratio at or below 3 times net debt to EBITDA by the end of our fiscal year 2027. This level of leverage provides financial flexibility for a balanced approach to capital deployment and the opportunity to consider share repurchases. Let me now provide an update on our outlook for fiscal year 2026. This guidance reflects the company's current expectation as it continues to operate in a dynamic and evolving external environment. Subsequent to our third quarter, a fire occurred at our Emporia, Kansas manufacturing facility, resulting in a temporary disruption of production for our Sweet Baked Snacks business. We estimate the incident will reduce net sales by approximately $25 million in our fourth quarter of this fiscal year, which resulted in the change to our net sales outlook at the midpoint relative to our previous guidance range. We are maintaining the adjusted earnings per share and free cash flow guidance for our fiscal year. We now anticipate full-year net sales to increase 3.5% to 4% compared to the prior year. This guidance reflects a $135 million headwind from lapping sales of the divested Voortman business and certain sweet baked snacks value brands, and a $38 million impact from reduced contract manufacturing sales related to the divested pet food brands as the arrangement was exited last fiscal year. We expect comparable net sales to increase approximately 5.25% at the midpoint of our guidance range, which includes the unfavorable impact of reduced contract manufacturing sales related to the divested pet food brands. This growth reflects higher net price realization versus the prior year, primarily due to pricing actions across our coffee portfolio in response to higher green coffee costs. The increase in comparable net sales reflects volume mix growth for the Café Bustelo, Uncrustables, and Meow Mix brands and the away-from-home business versus the prior year. Our fiscal year 2026 net sales guidance primarily reflects the following changes from our previous expectations. Higher net sales in U.S. retail coffee for the fiscal year, reflecting better than anticipated net sales in the third quarter. We continue to expect our fourth quarter will demonstrate an approximate 20% increase from net price realization, partially offset by a high single-digit volume mix decline, reflecting a strong prior year comparison and timing of promotional activities. In addition, we now expect lower net sales in sweet baked snacks, reflecting updated business assumptions and the estimated impact from the recent fire at the Emporia, Kansas manufacturing facility in February. We now anticipate net sales in the segment will decline low teen % in our fourth quarter given these factors. We continue to anticipate an adjusted gross profit margin of approximately 35% for the fiscal year. We now expect SD&A expenses to be flat to slightly down versus the prior year, primarily reflecting benefits from cost savings initiatives and reduced spend across the company. Total marketing expense is estimated to be approximately 5.5% of net sales, reflecting an increase in absolute marketing dollars versus the prior year, which reflects increased investments for the Uncrustables and Café Bustelo brands. We anticipate net interest expense of approximately $380 million and an adjusted effective income tax rate of 24%, along with a full-year weighted average share count of 106.9 million. Taking all these factors into consideration, we are maintaining our full-year adjusted earnings per share guidance range of $8.75 to $9.25, with $9 at the midpoint. We continue to project free cash flow of approximately $975 million at the midpoint of our adjusted earnings per share guidance range, with capital expenditures of $325 million for the year. Other key assumptions affecting cash flow include depreciation expense of approximately $350 million, amortization expense of approximately $210 million, share-based compensation expense of $35 million, and other non-cash charges of $100 million. In closing, we are pleased with our third quarter results and remain focused on maintaining a disciplined and responsible financial approach as we navigate this fiscal year. We are continuing to invest strategically in our key growth platforms and are confident in our ability to deliver long-term growth and increase shareholder value. Our earnings momentum this fiscal year is setting us up for an algorithm year or potentially better in fiscal year 2027, absent any significant changes. I would like to express my sincere appreciation for our employees. Their commitment to executing with excellence and their passion for our company positions us for continued success. Thank you.
Good morning and welcome to the J.M. Smucker Company's fiscal 2026 third quarter earnings question and answer session. This conference call is being recorded and all participants are in a listen-only mode. Please limit yourself to 2 questions and re-queue if you have additional questions. I will now turn the conference call over to Crystal Beiting, Vice President, Investor Relations and Financial Planning and Analysis. Thank you. You may begin.
Good morning, and thank you for joining our fiscal 2026 third quarter earnings question and answer session. I hope everyone had a chance to review our results as detailed in this morning's press release and management's prepared remarks, which are available on our corporate website at jmsmucker.com. We will also post an audio replay of this call at the conclusion of this morning's Q&A session. During today's call, we may make forward-looking statements that reflect our current expectations about future plans and performance. These statements rely on assumptions and estimates, and actual results may differ materially due to risks and uncertainties. Additionally, we will use non-GAAP results to evaluate performance internally. I encourage you to read the full disclosure concerning forward-looking statements and details on our non-GAAP measures in this morning's press release. Participating on this call are Mark Smucker, Chief Executive Officer, President, and Chair of the Board, and Tucker Marshall, Chief Financial Officer, Executive Vice President, Frozen Handheld and Spreads, and Sweet Baked Snacks. We will now open the call for questions. Operator, please queue up the first question.
Thank you. The question and answer session will begin at this time. If you are using a speakerphone, please pick up the handset before pressing any numbers. Should you have a question, please press star 1 on your telephone. If you wish to withdraw your question, please press star 2. For operator assistance, please press star 0. As a reminder, please limit yourself to 2 questions during the Q&A session. Should you have additional questions, you may re-queue, and the company will take questions as time allows. Please stand by for the first question. Our first question comes from Andrew Lazar with Barclays. Please begin.
Great. Thanks so much. Good morning, everybody. Mark, I'm curious. Morning. I'm curious. Maybe in your discussions thus far with Elliott, I'm curious where maybe you are seeing the most common ground, and where maybe the biggest opportunities are going forward. Is it potentially in more aggressive portfolio optimization, or maybe should we be thinking more on the cost side and sort of capital allocation fronts?
Thanks, Andrew. The engagement with Elliott is recent and has actually been very constructive. We've had a number of meetings with the folks there, and largely what they see is what many of you already know. We're a great company with strong brands. And there's really good alignment between what they're seeing and what we are seeing, focusing on continuing operating improvements, which will lead to profit restoration over time, the continued portfolio management, in the near term, focusing on organic growth, also disciplined capital allocation, and then lastly, governance. And as you know, we do and have continued a pretty consistent board evolution over the last 5 years. And these 2 recent additions of Bruce Chung and Dave Singer will further that governance. And in particular, making sure that we have the right support in terms of how we're thinking about capital allocation and our financial priorities. So really feel very good about where we are in the conversations with Elliott, and very confident that we have both the right board and the right team to continue to drive our strategy and the growth of the company.
Great. Thanks for that. And then you already discussed, I know, some of the change in promotional strategy and Sweet Baked Snacks at CAGNY last week, but maybe I'd love to dig in just a little bit further on sort of what you're really trying to accomplish with this move, and maybe what you're hoping to learn about the business through this action. Thanks so much.
Sure, Andrew. I mean, again, we are going to continue to focus on stabilizing the brand and return Hostess to growth over time. That includes strengthening the portfolio. As you know, we've done some SKU rationalization, really staying focused on the icon brands of cupcakes, Twinkies, and donuts. Continuing to, as I just mentioned, improve operations, which will ultimately lead to improved profitability. And then just taking a prudent approach to the investments in Sweet Baked Snacks to ensure that we're balancing both top line stabilization and profit improvement. And of course, we did take an updated assumption of 2% growth trajectory going forward, but we are continuing at this time just to stabilize the business.
Thanks so much.
Thank you. Our next question comes from Peter Galbo of Bank of America. Please proceed.
Hey, good morning, Mark and Tucker. Thanks for the question.
Morning.
Mark, maybe just to dovetail off of that, I noted in the profile on Bruce specifically, just his background in M&A. So just the thought process there of his experience, whether that could maybe accelerate a more portfolio reshaping, and then just like how you would think about use of proceeds. I think in the past, again, we know that the debt pay down piece, but in the past, as you've parted with businesses, you've been willing to kind of return that in the form of share repurchase, and just how that whole framework is entering your mind. Thanks very much.
Sure. Yeah. We've been in conversations with Bruce for some time, and just feel very good about his financial acumen. And as it relates to the portfolio, as we've been very consistent over the years in making sure that all of our shareholders understand that we always are reviewing our portfolio. We really like our portfolio because of the diversity. It obviously pet and coffee, and then food and snacking. We play across multiple categories, so the diversity does give us optionality. And as we've been very disciplined over these past years in reshaping our portfolio, that's something that we will continue to think about as we move forward.
Peter, good morning. As it relates to use of proceeds, we would just acknowledge historically we've used proceeds from divestiture activity to either pay down debt or to repurchase shares. As we continue on our path to 3x leverage or below by the end of next fiscal year, that enables the opportunity to consider share repurchases again.
Great. Thank you for that. And Tucker, maybe just to pivot to the business and coffee specifically, I think at CAGNY you had some remarks about near-term margin improvement that was predicated on some of the deflation in green coffee costs. You have a peer who obviously participates in the space that kind of talked about a recovery in some of the profit metrics in like the second half of calendar 26. And I know your fiscal is a bit different, but maybe you could put some guardrails around how you're thinking about that, coffee deflation entering the P&L from a calendar 26 perspective. Thanks very much.
Sure. Peter, the outlook for our coffee portfolio is positive. It starts with the resilience and the strength of the category, and also the performance of our brands. And we don't disclose our hedging or our cost position, but we do hedge for flexibility to support annual profit delivery. And we would just share that, as we mentioned at CAGNY, deflation benefits both the absolute profit dollar and the profit margin percentage. And additionally, we will be lapping the impact of tariffs. And so we would anticipate profit and margin improvement as we move forward. And in the fourth quarter of this fiscal year, we would expect a mid-20s segment profit margin. And so hopefully this continues to inure to the benefit of the portfolio and the profitability of the portfolio.
Okay, thank you.
Thank you. Our next question comes from Peter Grom of UBS. Please go ahead.
Great. Thank you. Good morning, everyone. So I was hoping to get some perspective on the top line trajectory. Maybe first, as it relates to sweet baked snacks, you touched on some of the drivers around the 4Q low double-digit decline. But I'd be curious how we should be thinking about fiscal 27 in the context of this exit rate. Would you anticipate some of the changes you're making to drive stronger growth, or is this kind of low double-digit decline a fair run rate as you move into the first half of next year?
Yeah, Peter, I certainly appreciate the question, particularly as it relates to the growth trajectory on sweet baked snacks. We'll just share that it's early for us to lean into what the outlook is for FY27. We have acknowledged that our fourth quarter will be a softer quarter for the portfolio, just as it relates to some of the category trends that it's navigating, but also as it overcomes a temporary disruption associated with a plant or manufacturing fire. And so I would just sort of think through that we continue to advance the stabilization efforts across that portfolio to improve our share of market performance. We've obviously worked through some of the SKU rationalization efforts. We'll continue to improve profitability across that portfolio. We'll begin to see the benefits of a recent plant closure, the Indianapolis facility, and we'll continue to look toward advancing growth over time. But this continues to be a journey as we navigate the stabilization of this portfolio.
Awesome. Thank you. And then I guess just a follow-up on coffee. There was some commentary earlier this week from one of your peers on some retail inventory dynamics happening in pods that they are expecting to impact their growth in the first half of the year. So is this a dynamic that you are seeing or contemplating in your guidance? Thanks.
No, Peter, we haven't seen any abnormalities in terms of inventories on coffee. Our coffee business continues to perform very well and obviously delivered great growth on Bustelo, and we'll continue to do the right thing for our coffee business.
Great. Thank you so much. I'll pass it on.
Our next question comes from Robert Moskow with TD Cowen. Please proceed.
Hi, thanks for the question. I was hoping to drill down even further into the coffee pricing strategy and maybe ask you to delineate between ground coffee and the single-serve pods. As your costs come down, would it be fair to say that the give back on pricing would be more on the ground coffee than it would be on the pods, just because of how it plays out on a percentage of cost of goods?
Yeah, Rob, I think it's early for us to talk about sort of the magnitude of deflation and its implication to pricing. But as you know, roast and ground is a greater percentage of coffee in the can as compared to in a single-serve K-cup. And so we'll continue to navigate the level of deflation and how we address deflation in our portfolio as we move forward. But I guess I would just leave it there.
Yeah, Rob, it's Mark. The only thing I would maybe just build is that, we've been pretty consistent over the years highlighting that the profitability and the margins across the coffee portfolio are generally similar.
Mm-hmm. Okay. And can I ask a follow-up on Hostess and sweet baked snacks in general? Since you bought the business, a lot of the management team and probably the next level down, has left the business. And I'm just wondering, do you think that you need to make a bigger investment in talent or capabilities in order to stabilize the business? And have those departures, do you think, contributed to some of the weakness in the division?
No, Rob. I'm very confident that we have the right team in place on Hostess, some of the best and brightest. I think what we're navigating is both the category dynamic and then, just as Tucker mentioned, just some operational challenges that we've had. We are through the Indy closure, which, as you know, was a bit more costly than we had anticipated, but that is largely behind us. And so our focus now is to maintain and improve the operating efficiencies, and then to continue to make prudent investments on those parts of the branded Hostess portfolio that are truly going to help to stabilize the business and then ultimately get us back to some growth.
Okay. Thanks for answering the question. Appreciate it.
Thanks, Rob.
Thank you. Our next question comes from Thomas Palmer of JP Morgan. Please go ahead.
Good morning. Thanks for the question. I think my questions are not going to be totally different than the two topics we've addressed so far, but just first on sweet baked snacks. I think a quarter ago the message was that the earnings pressures would be greatest in the second quarter, and then we'd see sequential improvement. So what really, I know there's the plant fire in 4Q, but what really were the incremental items to think about in 3Q that drove the weakness? I know you've mentioned the plant closure. Was that it, or were there other items to really consider? Because I'm trying to think through the ultimate recovery here and kind of how much is simply volumes need to reverse versus you have kind of a clear line of sight operationally. Thanks.
Yeah, Tom, what we would offer in our third quarter is top line did come in below our expectations, largely due to category trends, some of our own execution. And then I would also share that our bakery network costs came in much higher than we anticipated. And those two things really worked against the profit expectation of sequential improvement as we move through this fiscal year. And I would just say that our fourth quarter should be better, but it will absorb the impact of the fire in the month of February, both at top line and bottom line.
Okay. Thank you for that. And on coffee, and I apologize if I missed this, you have been providing some kind of clear guidance over the expected coffee impact in fiscal 26. I think last time it was, and even last week, you were discussing a 50-cent unmitigated tariff headwind. And then coming out of the second quarter, the coffee elasticity was expected to be a 40-cent headwind. Just any update on these items' expected impact now as we think about fiscal 26, and especially when it comes to the tariff headwind, is that an item we should essentially think about reversing in full as we look at next year, given it's unmitigated?
Yeah, Tom, so a couple of parts to break down there. Let's begin with tariffs. So we did call out a $75 million unmitigated tariff impact that was affecting this fiscal year that we would be lapping next fiscal year. So you can add that back to exit segment profit for this fiscal year. Then we would also just acknowledge, while we didn't update our elasticity impact in this call, we would just say that elasticities came in better than anticipated in our third quarter. And we continue to take a prudent approach to forecasting elasticities, in our fourth quarter.
Okay, understood. Thank you.
Thank you. Our next question comes from Chris Carey of Wells Fargo Securities. Please go ahead.
Morning, guys. I do want to ask one follow-up on the sweet baked snack segment. Then I promise my other question will be something else. But I think the organic sales in the quarter were pretty substantially below consumption, at least on our data. Why was that? What drove the gap between consumption and what you reported? And I just wonder if we should expect that going forward. And then just connected, when you talk about fiscal 27 being on algorithm or potentially better, within that statement, how are you ring fencing the sweet baked snack segment? Because back to Tom's point, obviously a quarter ago there were different expectations than what played out. So just trying to understand the cushion in that fiscal 27 statement as it pertains to sweet baked.
Yeah. So Chris, your first question on sweet baked snacks, I think we saw some timing around operational efficiencies and consumption, just as we've navigated sort of the resetting of the bakery network. We've also reset promotional activity in the back half on that business, where we've pulled promotional activity largely in support of then putting it back in to make sure that we're getting the most efficiency out of that spend. And then as you step into next fiscal year, I think it's hard for us to sort of communicate at this time the trajectory of the top line of the business. But we should begin to build back profitability because we're at such a low watermark at this point in time.
Okay. In the pet segment for the quarter, you were lapping some headwinds from the year ago period in the top line. How should we think about the performance for pet in the quarter? I think it came in a bit light of expectations. perhaps those expectations were a function of that compare in the base period. So I wonder if you could just maybe contextualize how you all felt about delivery in the quarter and whether there were any shortfalls relative to your own expectations. Thank you.
Sure, Chris. It's Mark. Overall, very pleased with the pet performance. I think, Meow Mix continues its growth trajectory. Still the number one leader in dry. Solid consumption, 5% top line growth in the quarter. Innovation is performing well. The Gravy Bursts platform that we've launched has done well, and we're actually expanding that with some new items. Milk-Bone specifically did start to grow again in the quarter, which is what we wanted to see. Was supported by base biscuits. We did see some decent growth in base biscuits, which is important. And then the innovation there with the Peanut Buttery Bites platform. We talked about a new iteration of that innovation at CAGNY. That innovation continues to perform well. The tail of the pet business, which is Pupperoni and Canine Carryout, continues to be soft, largely driven by competition and private label. But we have begun a brand refresh on Pup and continue to invest in marketing to support the business. And we do see strong loyalty there. So we think that will take time, but just keeping in mind that our focus on dog snacks will continue to be on Milk-Bone, and in that brand specifically playing across multiple segments, both premium to value and different need states for dogs. So Milk-Bone will continue to be, sort of the crown jewel, and we'll continue to focus there and continue to drive growth as we seek to stabilize the Pupperoni business.
Okay. Thank you both.
Thank you. Our next question comes from the line of Max Gumport of BNP Paribas. Please proceed.
Hey, thanks for the question. I've got one more on sweet baked snacks to throw in, and it's on the profit side. So I recognize that this year has been impacted by a number of discrete items, and also that you've brought down the long-term sales growth target for the business. But it felt like you had a clear path to returning to a 20% segment profit margin for sweet baked snacks, if not in 4Q, then sometime soon. So not asking you to put a timeline on it. I'm just curious if you have any color you can provide on what you view now as a reasonable, normalized segment profit margin for sweet baked snacks whenever you get back to that normal period. Thanks very much.
Max, excuse me, certainly understand the question, and obviously profitability is below our expectations, in particular in our third quarter. We should see an improvement into our fourth quarter from a profit standpoint. And then as we get to our fourth quarter earnings call, we'll be able to kind of lay out how we see the profit trajectory of the business and also maybe a revised profit margin target to your question. I just think right now the team still continues to advance its stabilization journey around improving profits. And that's really going to come through how we continue to navigate our bakery environment and manage overall costs.
Great. Thanks very much. And then on Uncrustables, so it was good to see that the total company business for Uncrustables growing 10%. I think retail was a bit slower at 6%. I recognize that doesn't have the C-store business being booked under it. But just curious for an update on how you view these trends for Uncrustables and how you're thinking about that business as you are getting close to the $1 billion target for revenue. Thanks very much.
Sure, Max. Uncrustables still feeling great about, of course. Obviously, you highlighted the numbers. It will continue to be a key growth driver for the company. Our distribution gains, most recently in away from home and C-store, having tripled our C-store sales and continuing to add new households on the order of like 3.5 million new households. So the expansion of the brand, supported by strong in-store merchandising, consistent marketing, share of voice, and then innovation, we believe will continue to drive growth there. And so as the category has expanded, right, and you are starting to see some store brands fill out the section, we remain the leader. And so our job is to continue to bring insights to customers so that we can collectively grow the category and specifically the Uncrustables brand.
Great. Thanks very much.
Thank you.
Thank you. Our next question comes from Megan Clapp of Morgan Stanley. Please go ahead.
Hi, good morning. Thanks so much. A couple quick ones from me. On the EPS guide, you kept the guide. It's still quite wide, I think, for this point in the year. I think historically you've narrowed it a bit with one quarter left. So you narrowed the top line. Can you just talk about the decision to keep the EPS range where it is and, whether you're tracking towards one end or the other at this point? Thanks.
Sure. I think we're just continuing to maintain prudence throughout our fiscal year as we deliver against the midpoint of that guidance range. We feel very confident in achieving the $9 midpoint, and any upside would largely come through your coffee portfolio. But candidly, the coffee portfolio is covering softness that we're experiencing in our sweet baked snacks portfolio. But the balance of the businesses continue in line with expectations. So that was really the reason we remain confident in the range. We remain most confident at the midpoint.
Okay, great. That's helpful. And then just on the SD&A, I think it's now you're expecting flat to slightly down versus flat prior. Can you just unpack a little bit more what changed there? Is that just efficiencies coming in better than you expected, or are you pulling back in any certain areas that maybe would need to come back next year? Thanks.
Yes, Megan. They're largely driven by efficiencies and just prudent management of spend.
Okay, great. Thank you.
Thanks.
Thank you. Our next question comes from Alexia Howard of Bernstein. Please go ahead.
Thank you for the question. Can I just follow up on Megan's question just there about the SD&A line? I think in the prepared remarks you commented that you had lower marketing and distribution spending this quarter, but higher selling expenses. Is that a signal of a continuation of that kind of trend going forward out into next quarter and perhaps out into fiscal 27, or should we expect some normalization of that?
No, we just had some savings and timing in our third quarter. Again, that supported the over-delivery in EPS. We've essentially locked that into our earnings guidance for the year. But we have some top-line softness coming through associated with the Emporia, Kansas fire. And so that's kind of muting some of the savings from a bottom-line standpoint. But there's nothing substantial to report in additional savings that would come through our fourth quarter.
Thank you. And then on the pace of innovation, have you quantified recently where you're at in terms of new products as a percent of sales and where you would hope to get to over time? Are you where you want to be on the innovation front now? Thank you, and I'll pass it on.
Alexia, I'm not 100% sure I understood the question. Let me try to answer it, and then please come back. It's Mark, of course. Innovation is actually performing very well. We've gotten, as we always do, listening to the consumer, making sure that we understand what their needs are and trying to meet them as quickly as possible. I mentioned some of the pet innovation. Even on Hostess, despite some of the challenges we've had on that business, the innovation there has actually performed well. That's also true in Bustelo, Uncrustables, and a lot of the innovation that has been successful is generally closer in innovation as opposed to big bet innovation, and that has really driven growth and help to support the top line.
Thank you. That's helpful. And the overall pace, the proportion of sales that are coming from new products, is that where you want it to be now?
Yeah, it's in line for sure.
Great. Thank you very much. I'll pass it on.
Thank you.
Thank you. Our next question comes from Scott Marks of Jefferies. Please go ahead.
Hey, good morning, all. Thanks so much for taking our questions. First thing I wanted to ask about, just on the dog snack side of the business, you made a comment in the prepared remarks about the category as a whole rebounding, and just wondering if you can kind of help us understand a little bit about what's going on there and what's changed relative to some prior quarters where you've called out some discretionary spending pressure on the consumer.
Sure, Scott. It's Mark. Both of the categories that we participate in pet are doing very well. And in particular, dog snacks has continued to grow. A lot of that growth has been driven by the humanization and premiumization trends in pet. So to the extent, as I mentioned in Alexia's last question, the innovation that has been delivering against that premiumization concept. In addition, as I mentioned earlier, we have been pleased with the base biscuit performance, which is the more affordable, more value-oriented part of the portfolio. So our strategy is to continue to make sure that we're winning in the different segments within that category, and continue to follow both consumer needs and where the growth is.
Appreciate the color there. Last one for me would just be regarding the Uncrustables business. You made some comments in the prepared remarks just about distribution runway in some of the away-from-home channels, talked about convenience channel. Maybe how should we be thinking about kind of the I guess, more traditional channels just in terms of, distribution runway left versus, maybe, innovations on shelf, just trying to contextualize how we should be thinking about maybe velocity improvements versus innovation in some of the larger or more mature channels for that business.
Yeah, in the traditional U.S. retail channels like grocery and mass, our distribution has expanded over the last year as we've actually gained more freezer space. As new capacity came on at our facilities, that enabled our ability to deliver more innovation and meet demand. So at the same time we were ramping up manufacturing, we were also turning on marketing. So that did drive distribution. I would say generally we're everywhere with Uncrustables, and our continued growth is going to be driven largely by innovation. Obviously, like these new high-protein sandwiches are doing very well, and then continuing to drive household penetration where we still feel there is some runway.
Appreciate the thoughts. I'll pass it on.
Thank you. Our next question comes from Steve Powers of Deutsche Bank. Please go ahead.
Hey, thanks very much, and good morning, everybody.
Morning.
Most of my questions I think have been addressed. It's been a nice compliment today to what you said at CAGNY, so thank you for that. I did have one, I guess, more technical question though on sweet baked snacks. It's probably for Tucker. Specifically, I just wanted to ask around the decision to start regularly amortizing the Hostess trademark beginning in the fourth quarter. Just maybe you could talk a little bit about the trigger for that, and I guess over what period of time you're now assuming that brand will, I guess, effectively depreciate.
Yeah, so as we have looked across the portfolio and as we continue to evaluate the direction of the sweet baked goods category and our brands and brands in that category, we have slowed the growth rate from our original expectations at the time of acquisition, and now we have a long-term growth rate of 2%. As we've reduced that growth rate, and Mark shared in his comments and also in Q&A, we want to continue to take a prudent approach to how we invest behind that business and those brands, and how we allocate resources not only to that aspect of our portfolio, but how we allocate resources toward our broader portfolio. It just came to us that we should begin amortizing that brand over a longer period of time versus it being an indefinite-lived one. And that's really what we were trying to signal in my prepared remarks here today. So hopefully, Steve, that just provides some additional context.
It does. Maybe it'll be in the queue, but is there a life, just a rate, I guess, a time span of depreciation or amortization we should be thinking about?
Yeah, so our outlook for amortization for the full year is now $210 million. That includes the step up in amortization that begins in the fourth quarter by putting that brand on a life, and we will continue to provide updates as it relates to that amortization as we move forward.
Okay, that's helpful. I appreciate it. Thank you.
Sure.
Thanks.
Thank you. There are no further questions. I'll pass the call back over to management for any closing remarks.
Well, thank you for your time and for joining the call this morning. It was great seeing many of you at CAGNY last week, where we outlined our objectives focused on continuing to advance our long-term growth strategy and furthering momentum of our portfolio of leading brands, improving profitability and earnings growth, and continuing a disciplined capital deployment scheme. Our results demonstrate our strategy is working, and we continue to take deliberate actions to advance these objectives. I'm confident that we have the right strategy and leaders in place to create value for our shareholders. And none of this would be possible without our dedicated employees for their unwavering commitment and outstanding talents and contributions. And I would like to thank them for their continued hard work and dedication to our company. Have a great day, everyone.
Everyone, this concludes our conference call for today. Thank you all for participating and have a nice day. All parties may now disconnect.